Hello, everyone, and welcome to this, which is session 4 of 10 of the Pillar 2 technical series run by Forviz Mazar. So I'm Neil Rolfe, and joining me today, let's just go to this slide. We've got Scott Austin and Reshma Bikram. So this session today is covering the accounting, and previous sessions, and those are available to those registered in the series, have covered the high-level Pillar 2 Globe concepts. So that includes the IIR, the UTPR, the charging mechanisms, also the transitional measures. The transitional measures, you may remember, are based predominantly around the country-by-country report and ensuring that you have a qualified country-by-country report. But then after that, you also have the deferred tax numbers that you need to include within your transitional measures calculations, those deferred tax numbers coming ordinarily from your consolidated accounts package system. And then in the eventuality that you need to do a full model rules calculation, you have a starting point of the FANIL, which is the financial accounting net income and loss, and you have adjustments that you make to that in order to get to the globe income. You also have then the tax number, so the covered taxes, where you take tax number, where you have to identify what are your covered taxes, and then you make some quite significant adjustments to those covered tax amounts as well to get to adjusted covered taxes. One of the more complex areas of those adjustments is around deferred tax, where you have to take deferred tax balances, you have to rebase everything to 15%, you make adjustments for deferred tax assets and losses. And so the tax accounting is, to put it bluntly, fundamental to Pillar 2. And what we find amongst quite a large number of particularly our legal colleagues, but also more generally, not everybody who's involved in Pillar 2 tax is a tax accounting specialist. And to be able to understand the next two topics, which will be around the adjustments to FANIL to get to the globe income and the adjustments to covered taxes to get to adjusted covered taxes, you really need to understand how tax accounting works. And so today we've got Scott Austin and Reshma Bikram, and I'll allow Reshma to introduce herself now, but they will be taking you through the key concepts and just quickly touching on why it's important again. So Reshma.
Hi all, my name is Reshma Bikram and I'm a tax director based in the Netherlands with over 10 years of experience in tax accounting and one of the Pillar 2 specialists in the Netherlands. Scott, can you introduce yourself?
Sure, Reshma, thank you. My name is Scott Austin. I've been doing income tax accounting in various roles, either at public accounting or as a VP at a Fortune 500 organization for over 25 years now. So I have the pleasure, along with Reshma and Neil, to try to teach you or introduce you to income tax accounting that we've learned over our 10 and 25 years in about 20 to 50 minutes here. So with that, we'll move on. Neil's pretty much talked about the agenda, but specifically, we'll go over some tax accounting basics and then look at some of the items involved and included in computing the Pillar 2 Globe type rules here, specifically focusing on effective tax rate and the top-up tax, the computation of income or loss, adjusted covered taxes, and then I'll come back and close a little bit more with some reporting obligations along the way. So with that, we'll go ahead and jump right in. So we'll be starting with tax accounting basics. So, with tax accounting basics, we're trying here to make sure that everyone has the opportunity to understand some of the terms and kind of level set and give everybody some background information regarding income tax accounting, because understanding these basics are very important for doing all your Pillar 2 modeling and calculations, primarily the aspect of deferred taxes as well as the tax rate, which will be recognized typically through the rate recognition type items. In addition, as we mentioned, we'll close with some disclosure matters, and this is very important part of it, especially as we're making significant changes for many companies as they adopt and determine how Pillar 2 is going to impact their operations. So in kind of addressing the core of this slide, we start with accounting, and we generally have one set of books for an organization that follows financial accounting principles. That may be under GAAP, which could be US GAAP, or it could be under IFR standards. And generally what my experience has been that there's much more similarities than differences between GAAP and IFRS. However, there are some differences, and really what's critical here is to understand those key differences in the jurisdictions your company does business in, as well as just how that whole process flows together. The second set of books that we really commonly refer to is our tax records. Generally, our tax records are driven under the foundation of the first set of books, or the financial accounting information. And from that, we generally just track the adjustments to our financials that are necessary to file our tax returns and our tax records. Ultimately, we then end up with income tax accounting. And income tax accounting seeks to bridge the timing of recognition for taxes paid in the current period or current taxes, and the recognition of all tax expense related to current business activity. On its most basic level, income tax accounting seeks to record an income tax expense for book purposes that represents the tax due related to all the activity booked in a period. It's really part of the matching principle, as denoted there in the first paragraph. To the extent that some of the activity in our books and records aren't taxed at all, we have permanent items. Other differences are primarily related to timing items, where the timing of recognition for tax purposes often is accelerated or deferred. So in that regard, the next piece that's really important is the rate reconciliation and disclosure that are also important. The rate reconciliation essentially compares the effective tax rate of the company to the tax rate for the company's primary jurisdiction. So for example, in the US, that would be comparing it back to 21% plus whatever the state rate, effective rate is. So commonly that's in the 24 to 25% range total. Disclosure seeks to add qualitative information regarding material items impacting the company's taxes. We'll get more into that in a few minutes. So before 2024, we had, statutory reports, legal entity financials for various countries, various reasons. We had consolidated group financials. Then we had the accounting for tax support, essentially tax return accounting. And then we had income tax accounting. Now with Pillar 2, we have what some people would refer to as an additional set of books, which essentially requires us to look at the value of the assets and liabilities and treat them differently from a deferred tax standpoint, as well as the underlying Pillar 2 deferred taxes will be very important. As we move to slide 8, we look at the various types of information that can be found in the financial statements. On the balance sheet, which I'm not going to follow the order of that's on the slide here necessarily, but on the balance sheet, we have current tax payable and receivable will be found on the balance sheet. This is essentially the amount that would be the settle-up payment compared to what has been recorded if you filed a tax return at the end of the financial statement period. We also have deferred tax balances. So this is the amount of future tax benefit or detriment related to the cumulative timing differences that are on the balance sheet. You would also find valuation allowance items, which would be part of kind of your deferred tax balances, which would be the recognition of any impairment or any reserve necessary if it is not more likely than not that any deferred tax asset could be recovered based upon either an expectation of future income or temporary timing differences that would turn. And then also on the balance sheet, you'll see any liability for uncertain tax positions. On the income statement, you'll see more period items. You'll see a current tax expense, which should be the cumulative amount of tax shown on tax returns for the year in every jurisdiction. Plus, there will be some element of true-ups. So, for example, you'll have financial statements are typically filed for a U.S. calendar year taxpayer in February or March, and then the tax returns are put together and filed later in the summer or in the fall. And so you don't necessarily have all the information included in the tax return available at the time of filing the financial statements. So anytime there is a difference, there's a tax return true-up or provision to return true-up that is recorded shortly after the tax returns are filed. That would typically be shown in the current tax expense as well. You'll also have a deferred tax expense, which is the change during the year to reflect the differences between the cumulative timing differences at the beginning and the end of the year. Usually that is anything that results from business activity during the year, or there could be a change in the statutory tax rate in jurisdictions or other adjustments. You'll also see any change in valuation allowances, change in uncertain tax positions as well on the income statement, just the annual activity. In the cash flow statement, you'll see the amount of income tax payments or refunds received during the period. And then finally, you'll have disclosures. These will come in a couple of different places. One, you'll have your accounting policies descriptions that would give a general description on any policies that impact income tax accounting. And then you'll also have your income tax footnote. Your income tax footnote would typically have your rate reconciliation, a deferred tax table, more qualitative information on uncertain tax positions and information on any exams or statute of limitations and jurisdictions that the company may have. And in 2024, there'll often be disclosure regarding the impact of Pillar 2 to an organization. As we turn to slide 9, we have the 9-step tax accounting process. So essentially what we start is with identifying book to tax differences. So here the key is to understand the business well, and the difficulty of this section or this step is really dependent upon what type of organization is being accounted for at the time. You have an organization that has a lot of activity, a lot of acquisitions or divestitures. This could be quite complicated. If you have an organization that really has just stayed in the same jurisdictional footprint or really hasn't changed its business operations much, this could be as easy, not that it will be easy, but it could be essentially rolling over the existing book to tax differences from prior years. But I can't understate the importance of making sure that the business acumen and understanding what's happened in the underlying business is important. And that usually comes from a detailed reading of the financial statements and or communications with the controllers and other business leaders. We then move into calculating the current year tax expense. Essentially, this will be identifying any permanent or timing differences that exist and calculating the actual amount that is expected or estimated to be due on all the tax returns that will be filed for the organization. Then you go into the calculation of any prior year adjustments. This could be for a variety of reasons, like we said before, the return to provision true up, or it could be for other items, any changes in tax law, anything that maybe was an estimate from a prior year, maybe some kind of IRS settlement, et cetera. You then calculate the deferred tax and asset liabilities. So this will be on a balance sheet approach. And here we will compare the book basis of the assets and liabilities as of the balance sheet date and identify those differences. And then those are recorded at the tax rate for the jurisdiction those differences are in. So if you have depreciable property in multiple jurisdictions, you'll have to calculate your deferreds by jurisdiction and apply the appropriate rate, and then add them together to get the entire line. Additionally, with respect to deferred tax assets, particularly, you could have tax attributes that have value recorded. So here, where you have NOL carry forwards, tax credit carry forwards, et cetera, those would also be recorded as deferred tax assets. These assets specifically have to be considered for their recoverability. So this next step here, kind of the fifth step, in the middle arrow in the diagram, this is where we look and say, to the extent we have future tax benefits that are expected to be received, how do we know that we're actually going to benefit economically from those? So if you have NOLs, in order to get the economic benefit for those, you have to have taxable income or a reasonable expectation of taxable income in the future. You could also have deferred tax liabilities or bad guys that could come through and offset them as well. But this is the process where we evaluate that, and typically that's done by jurisdiction, separately, each jurisdiction as well. Then we have to identify exposures and report any uncertain tax positions. So uncertain tax positions are essentially positions that are taken on a tax return that may or may not be rise to the level of being highly certain. So we go through a two-step process. One is recognition, and that in order to recognize the benefit for financial statement purposes, even if it's on a tax return, you have to be at a more likely level of not than comfort. That level of comfort has to be derived at, assuming that it's going to be fully looked at. You can't really play the audit lottery, et cetera, in coming up to that level of comfort. Then you get into measurement. So in many cases, uncertain tax positions can be binary. You're either greater than 50% likely to sustain the benefit or not. But there are some types, specifically like R&D credits or transfer pricing adjustments, that you're confident that you're going to get some portion of the deduction, but they can be challenged. And so there are times where a haircut is taken to that benefit and recorded through the uncertain tax benefit line. We also then go to intra-period allocation, which would be how we divide the tax expense and tax accounts among the various sections of the financial statements. So this would be whether it's on the core P&L, whether there's any discontinued operations, other comprehensive income, or anything booked straight to equity. While that may have an impact to some of the Pillar 2 items, I think that's in a tax accounting basics, that's probably, we could spend a lot of time and not get a lot of benefit from going up much deeper into that section. The one area that we'll get a little bit more deeper into is preparing the effective tax rate reconciliation. So we have an example later, but in shorthand, the effective tax rate reconciliation basically just identifies the differences between the company's primary jurisdiction tax rate and the effective tax rate recognized in the financials. So we'll have differences for permanent items, we'll have differences related to any adjustments, and we'll show some of those particular ones here in a minute, an example. And then finally, we go through the disclosure step, which we'll talk about a little bit later as well. So now on slide 10 here, we'll go through some common permanent items. So we've listed some items here. I don't need to read them all off, but essentially here, I'll use meals and entertainment expenditures as an example. Here in the US, some meals and entertainment expenditures are partially deductible, some are wholly non-deductible. And so to the extent that they are not deductible, that would be a permanent difference. So those items will be recorded as an expense on a financial statement, but not recorded as an expense on your tax return. Similar things are true for fines and penalties. On the opposite side, sometimes you have revenue that's not subject to tax, so tax-exempt interest would be one of those. And then in the kind of the tax line itself, R&D incentives, sometimes R&D incentives are either a lower rate applies to R&D or some of the income could be exempt from tax as well. This is a little bit here where you have an asset to the extent you have book basis greater than tax basis. We'll have a deferred tax liability. If you have book basis less than tax basis, you have a deferred tax asset. Essentially, anytime you have a deductible temporary difference, you'll have something that results in a future tax benefit, you'll have a deferred tax asset. On the other side, you'll have a deferred tax liability whenever there's a future tax detriment or a taxable, otherwise referred to as a taxable temporary difference. We've got one more example, and then we'll have a polling question. So here, this is an example of this is incorrect. So the purpose of taking this example is to show this is what would happen if you didn't account for deferred taxes or timing differences in the financial statements. Essentially, this is a calculation that just says, in the current year, I'm going to pay $25 of tax. So that's a 12.5% effective tax rate on my 200 of income. And in the next year, when that 100 of temporary differences reverses, I'm going to pay $50 in tax, and my income's only 100. So as a result, I'm going to have a 50% rate of tax. That is not the appropriate approach. The appropriate approach is here on slide 13. So here we have the exact same facts as before, but we do record a deferred tax expense in year one because we have taken a tax benefit that reduced our current tax expense in the initial year of a tax benefit of 100 that reduced our expense by 25. And so that means on our balance sheet, we're going to have some future tax detriment. And in putting that up, that would be an additional 25, which gives us 50 of total tax expense or an effective tax rate of 25. The same thing reverses in the next year, and you can see the journal entries there on the right. Now we're going to move to the first polling question. Which of the following is an example of a temporary difference? A, differences in depreciation of fixed asset for book versus tax purposes. B, different book basis versus tax basis for a pension liability. C, for tax purposes, a loan that is reported at historic cost that for accounting purposes is recorded at fair value. Or D, all of the above. I think we can look and see. I didn't know whether there was any questions, Reshma, that have come in. Is there any that we want to address?
No, not yet, Scott.
Okay. Well, then with that, I'll go ahead and give you a little bit of time to answer the polling question. And then we'll be getting into a little bit more about the rate reconciliation. So here on slide 15, we have an outline of a rate reconciliation. Here on the first line, you would have your book income or loss, and then that would be multiplied on the second line by the statutory tax rate for the company's primary jurisdiction. In this case, we're using 25.8%. Then in each of these additional lines, they would be populated with the amount of the differences. So to the extent that you had non-deductible costs, let's say permanent differences from meals, entertainment, et cetera, that amount times the 25.8% would be an adjustment that would be shown here and ultimately would raise the effective tax rate as long as you had income. The same thing would be true to the extent you had untaxed dividends or R&D credits or benefits of any incentives or non-deductible interest, et cetera. You also, common items here will be prior year adjustments. Any time that there's a change in a tax rate, the deferred tax basis difference will stay the same, but the deferred tax amounts recorded on the financial statement will differ, and thus there will be tax rate adjustments to be recorded. Anytime that there's uncertain tax position differences within a year, since that doesn't affect income and it affects the tax rate, that would typically be shown up in the rate reconciliation as well as any other impairment of deferred tax assets, changes in valuation allowances, or any losses that couldn't be utilized. So now we're catching up on polling questions. Here's polling question number 2. Which of the following is an example of a reconciling item in the effective tax rate for accounting purposes? A, non-deductible expenses. B, valuation allowance or impairment of gross deferred tax assets. C, prior year provision to return adjustments. Or D, all of the above. It looks like as the answers are coming in that most of you, really all the answers are right, but the most correct is the bottom answer, and 3/4 of you are getting there. So with that, I'm going to turn it over to Reshma to talk about the next session, the computation of effective tax rate and top-up tax.
Yeah, thank you, Scott. We can't emphasize enough that it's important to understand the basic tax accounting principles. Scott closed his part with an ETR reconciliation for financial accounting. Let's now make that bridge to Chapter 5 of the Global Model Rules. For completeness sake, in this session, we're not going to discuss the transitional CBCR safe harbor rules, but be aware that one of the tests is a simplified ETR test, which is also calculated in a different manner. So when we're during this session, we're discussing the Pillar 2 ETR. It's the ETR as defined in Chapter 5 of the Global Rules. I also would like to emphasize that Chapter 3, the computation of the GLOBE income or loss, and Chapter 4, the computation of the adjusted covered taxes, will be covered during the sessions 5 and 6. I would absolutely recommend you to attend those sessions because there's a strong relation with today's session. And today we'll explain the relationship with tax accounting. So Chapter 5 includes the rules to determine the ETR of jurisdiction the multinational operates in. There's already an important difference here to mention. The Pillar 2 ETR is calculated on a jurisdiction level. What we'll also learn is that the Pillar 2 ETR is not calculated in the same manner as the ETR for financial statements. The Pillar 2 ETR will also not be part of the financial statements, nor will the Pillar 2 deferred taxes, only the top-up tax liability as of 24. So this slide is one of the slides presented in one of the previous sessions. And this slide mentions the 5 steps which are necessary to calculate the top-up tax liability for a multinational in scope of Pillar 2. The first step is discussed in the previous sessions. The next 2 steps will be discussed in sessions 5 and 6. And the steps 2 and 3 are important as this will be the starting point for the Pillar 2 ETR. So the next slide will illustrate this better. Once the top-up tax liability is calculated, the charging mechanism should be considered. That's step 5. So first, the primary rule, the IAR, should be considered at the parent entity level, and there's this backstop to avoid leakage, the UTPR. So this slide illustrates the calculation of the top-up tax liability. What you see here is that besides the calculation of the global jurisdictional ETR, there's also an excess profit calculation. The reason for including this substance-based carve-out based on payroll expenses and the tangible assets is to exclude a fixed return for substantive activities within jurisdiction from the application of the global rules. This reduces the excess profit and this reduces the top-up tax liability. So let's see where we can find the relevant articles to compute the ETR and top-up tax. So this is a summary of where you can find all the relevant articles in Chapter 5. I'm not going through them. It's more for your convenience to have that in the slide deck. But it's good to know that in December 21, the OECD published the Global Model Rules. And then the consolidated commentary on the GLOBE rules were published in April 24. This consolidated commentary incorporates the agreed administrative guidance up until December 23, meaning that the June 24 administrative guidance is not included in the consolidated commentary and should be considered in addition to the consolidated commentary. And the June 24 guidance is very important also because it includes a lot of explanation about how to deal with the DTL recapture rule, which we'll be covering also in a bit. So the Pillar 2 ETR is calculated by dividing the adjusted covered tax by the GLOBE income. Therefore, it's important to understand how to compute the adjusted covered tax and the GLOBE income. For financial accounting, we've seen that the reported tax expense in the P&L is divided by the profit before tax. So as mentioned before, GLOBE income will be covered in the next session, but I do want to emphasize that the GLOBE income is not the same as the profit before tax in the financial statements. So Chapter 3 sets out the computation of the GLOBE income or loss for each constituent entity. So these are the steps for the computation of the GLOBE income or loss. The starting point for determining a constituent entity's GLOBE income is the net income or loss that is used for preparing consolidated financial statements of the ultimate parent entity prior to elimination of intra-group items. In Article 3.1, there's an exception mentioned when this is not reasonable practicable for a constituent entity. An acceptable standard with some conditions is also allowed. And then we have some adjustments. Article 3.3 is the easy one. This covers the international shipping income inclusion. For example, companies using the tonnage tax regime or any other shipping as tax incentive will probably have an ETR below the 15%. This could lead to an additional top-up tax, which is not desired. Therefore, Article 3.3 is introduced for the maritime sector. The book to globe tax differences, as mentioned in Article 3.2, are probably more complex. We'll summarize them on the next slide for your convenience. When the globe income is determined, allocation between the main entity and the permanent establishments is required, also to owners of flow-through entities in accordance with local tax treatment. These allocation rules ensure an appropriate allocation of financial net income or loss between these entities and their owners in line with the applicable local tax rules. So once the financial accounting net income or loss of a constituent entity is determined, it is adjusted for certain book-to-tax differences, meaning differences between financial accounting results and taxable income results. Differences between financial accounting standards and tax accounting rules generally result into permanent differences or temporary differences. Well, Scott explained earlier that permanent differences will not reverse in a future period, and temporary differences will reverse in a future period. The adjustments mentioned in Article 3.2 are generally related to permanent differences between the treatment required under financial accounting rules and local tax rules. Temporary differences are addressed in Chapter 4, the adjusted covered tax chapter. To the extent an adjustment required by Article 3.2 excludes an amount of income from the globe income or loss computation, any covered taxes associated with that income must also be excluded from adjusted covered taxes. I'm referring to Article 4.1.3, paragraph A in this respect. This is not different from calculating an ETR for the financial statements. So I believe we're covered now 2/3 of our slides. Time for a polling question. Would you like us to contact you to further discuss tax accounting implication in relation to Pillar 2 or other tax accounting questions? We're now highlighting the basics, but we can imagine that a customized workshop would be interesting. Chapter 4 includes the rules that determine the amount of taxes that are to be associated with the globe income or loss determined in Chapter 3. Both the global income or loss and the adjusted covered taxes will be used to calculate the Pillar 2 ETR. Chapter 4 will be covered during session 6 in depth, and during this session we want to illustrate how certain adjustments affect the Pillar 2 ETR. The starting point for the computation of the taxes to be taken into account in the ETR calculation for global purposes is the current tax expense that is accrued in the financial accounting net income or loss of a constituent entity with respect to covered taxes. Article 4.2 sets out the definition of covered taxes that are taken into account in the determination of adjusted covered taxes under Article 4.1. The definition of covered taxes is developed solely for the purposes of the global rules. Article 4.4 includes a number of safeguards designed to protect the integrity of the ETR calculation under the global rules. These safeguards include, limiting the recognition of the deferred tax assets and liabilities to the minimum rate, that's 50%, and a recapture rule to ensure that amounts claimed as covered taxes are actually paid within a set period of time. Article 4.3 mentions that covered taxes are allocated to other constituent entities when necessary. Such taxes may require allocation, include CFC taxes, withholding tax, and tax in respect of permanent establishment, tax transparent entity, or a hybrid entity. And the final step relates to post-filing adjustments. The top-up tax liability is final after the Globe information return is filed. The question is how to deal with any changes to the accrued tax expense. The first information return should be filed no later than 18 months after the last day of the fiscal year in which the Pillar 2 rules apply. You can imagine that recalculating the entire top-up tax liability is quite complex. Article 4.6.1 mentions that an immaterial decrease of covered taxes, that's under €1 million, may be treated as a reduction to covered taxes in the current fiscal year. There's an annual election for that. This simplifies the computation of the top-up tax under global rules. Increases to covered taxes are only taken into account in the current fiscal year. So this slide summarizes the additions and the reductions to the covered taxes. And we'll go through some examples right now to illustrate how that works out. So this is an example of Article 4.2.1, paragraph A. This example illustrates that the ETR increases when, for example, withholding taxes are adjusted from above the line to below the line. And above the line, I mean it's booked in the OPEX, and below the line, then we mean that it's booked in the tax line. In this example, the amount of the withholding tax is 5. In the Pillar 2 ETR, the OPEX decreases from 50 to 45, and the tax expense increases with 5, resulting in a Pillar 2 ETR of 16.7%. For companies, it's important to know where the income tax is reported in the P&L. So allocating the income tax incorrect can mean that the ETR drops below 15%, while this is totally unnecessary. So this other example is about uncertain tax positions. This is an example of Article 4.1, paragraph A. This example illustrates that the ETR increases when, for example, this Article 4.1 mentions 2 corrections related to uncertain tax positions. Amounts paid in relation to uncertain tax positions can be added to the covered taxes. This excludes penalties and interest. The regular accruals for uncertain tax positions should be eliminated from the covered taxes. So the financial accounting standards, when it's US GAAP or IFRS, require that the reserve should be reported when there's an uncertainty about the filing position. If the filing position is accepted, the reserve will be released. Given the nature of this accrual, the movement in these amounts may not be included in the adjusted covered taxes until the amount is actually paid. This example illustrates the elimination of the accrual in the covered taxes. This example is about DTA for losses. So for financial accounting purposes, DTAs for losses, credits, and deductible temporary difference can only be recognized to the extent that it's probable or more likely than not that future taxable profits will be available. If this is not the case, under IFRS, an impairment of the DTA is booked. Under IFRS, under US GAAP, you will see a valuation allowance. This is a very simplified explanation, but in reality, this topic can be very complex. There are a lot of judgmental aspects included in a DTA assessment, so you can imagine that this topic can lead to a lot of discussions with your auditor. So the good news is that under Pillar 2, it's not necessary to assess the future taxable profits, because under Article 4.4, paragraph C, a DTA for a loss must always be recognized. If in year 2, for financial accounting purposes, the DTA is reported because the recognition criteria are met, to avoid double count, deferred tax benefit is disregarded under Article 4.41, paragraph C. Because under Pillar 2, the DTA was already recognized in year 1. Article 4.4 also mentions that deferred tax should also be recast to 15%, meaning that tax rate changes are not included in the Pillar 2 ETR. For financial accounting purposes, deferred positions are calculated against enacted tax rate, and if that changes, the deferred position needs to be recalculated against the new enacted tax rate, resulting in an effective tax rate change in the ETR. So the last topic in relation to Article 4.4 I would like to discuss today is the DTA recapture rule. Article 4.4.4 mentions that the accrual of a deferred tax liability that is claimed in the adjusted covered taxes, meaning that the deferred tax expense is part of the Pillar 2 ETR, shall be subject to recapture if it doesn't reverse within the subsequent 5 years. The purpose of the DTL recapture rule is to ensure that the ETR is not overstated when the DTL is not reversing within 5 years. To distinguish between short-term DTLs and long-term DTLs is therefore important under Pillar 2. Examples of long-term DTLs are, even indefinite, are goodwill, trademarks, or any other intangible. There are exceptions mentioned in Article 4.45, and Article 4.47 includes an election to not take into account deferred tax liabilities if it's expected not to reverse within 5 years. So the DTL recapture rules means that the adjusted covered tax and the ETR for the fiscal year in which the DTL was accrued needs to be recalculated. The DTL accrual will be eliminated, and if the ETR drops below the 50%, additional top-up tax will be the result. Article 5.4 should be considered in this respect. This article is about the calculation of additional top-up tax. The recapture rules requires tracking the reversal period for DTLs under the GLOBE rules. This means that the multinationals will need to develop a process in addition to their accounting process to determine whether DTLs reverse within 5 years or not. You can imagine that this required information for DTLs for only the recapture rule will be a challenge for multinationals. So the June 24 administrative guidance comes with a lot of examples of acceptable approaches for multinationals in this respect. So time for a polling question. Which of the following is an example of a reconciling item in the effective tax rate for Pillar 2 purposes? So this is specific for Pillar 2. Scott discussed the financial accounting ETR, which has different elements in the ETR. And for Pillar 2, you have some other reconciling items, or some reconciling items need to be eliminated. So tax rate changes. The deferred taxes are now, for Pillar 2 purposes, is calculated against the minimum tax rate. Yeah, so the tax rate changes will not impact the Pillar 2 ETR anymore, because the deferred taxes are set on the minimum tax rate. And for the uncertain tax positions, you can only include the actual payments and not the movements of uncertain tax positions. So the additions to the provision and the releases. So those amounts need to be eliminated from the Pillar 2 ETR. And deferred taxes for financial accounting, you need to assess the recoverability for the deferred taxes. So you have an impairment for IFRS or a valuation allowance, but for the Pillar 2, there's no impairment anymore. The DTA is set on 50%, no matter what the future taxable profits says. Before going to our final part of the presentation, needless to say that Pillar 2 will have an impact on the reporting process. The transitional CBCR safe harbor rules will postpone a little bit of the burden for most multinationals, but multinationals should continue modeling the GLOBE calculation, including building and process to meet compliance requirements. The current tax specs used will not include all data required to calculate a company's top-up tax liability. And as of 24, companies are expected to report this top-up tax liability. In 23, we saw that most companies in scope of Pillar 2 already disclosed the effect of Pillar 2 in the financial statements, quantitative and qualitative. So for your convenience, we summarize the relevant paragraphs for IFRS purposes. Scott will dive into the US GAAP requirements in a bit. The Pillar 2 deferred taxes shall not be disclosed in the financial statements. In 24, if applicable, the top-up tax will be reported and shall be disclosed separately under the current tax. Furthermore, information about being in scope of Pillar 2, update on relevant Pillar 2 legislation, and a qualitative and a quantitative impact analysis should be included in the disclosure note. Handing over to Scott now to discuss the US GAAP disclosure note requirements.
Thanks, Reshma. Yeah, so in February 23, the FASB staff announced that they view GLOBE minimum tax similar to the alternative minimum tax and similar to what is now the corporate AMT in the US. So being taxed as a minimum tax, it basically states that you have a current inclusion approach. It's a period cost. So you recognize the additional tax in the period that it's due. However, it is part of, it should be considered as you're setting your adjusted effective tax rate for the year and recorded along through each quarter during the period. There are some opportunities, some taxpayers early on could have made elections to do this under deferred tax accounting, but it's very rare. We don't see that very often. So in addition to being part of the estimated annual effective tax rate calculation, you also have to consider this when you do your intra-period allocation. So anything that goes to discontinued operations, OCI, et cetera. There are some differences in practices that are beginning to emerge with respect to valuation allowances. So we expect that there may be some additional future guidance coming out from the FASB. And at this point, we would say that the most important aspect of this is to be consistent. So once you make an election on how you're going to treat this, being consistent and following that. From a disclosure standpoint, from a qualitative kind of footnote disclosure standpoint, we would say that any potential material impact should be identified, adjusted, we should be looking or seeing in the various tax footnotes what the expected future impact is, some estimate of that, whether it's material or significant or immaterial. It doesn't necessarily have to be quantified, but should be in some type of qualitative terms. And typically we'll see which jurisdictions a taxpayer or a company operates in that may have an impact that is material. So those are the key elements from a standpoint of what we have been seeing or would expect to see in disclosure. We then get to this last slide, which is really, so what should we be doing? And I think the first thing to do is to model, understand where you're at, and make sure that to the extent that you evaluate whether you're in the safe harbor rules for the first few years of this. We see a lot of our clients that are putting in place or have put in place an implementation roadmap. Hopefully that's already done, but essentially you should be in the middle part of that road. But depending upon the size and the impact, there are clients out there, there are companies out there that are, kind of scrambling to catch up now. Another aspect of this is to make sure that you've identified the information that's needed to compute all the amounts and the different jurisdictions involved. And then, how do you get that data? Both from where are you pulling it from, but from a timing standpoint. And a lot of this information, it will be needed a couple of different times. It'll be needed first and foremost in setting the annual effective tax rate, if you think it's going to apply, but it will also be needed for actually filing forms and calculating the tax when you actually go to pay it, if it is required. How are you going to calculate it? How are you going to file the forms? And then along the lines of, are there any benefits that you might get from applying any of the elections? And then how are you going to actually complete the globe return? Sometimes this will be done in European tax departments for global organizations because of the more taxpayers that are filing in there. But oftentimes we see clients and targets, looking for service providers that can assist them in this process. With that, we have a couple minutes left, and I see we have a couple of questions here. Reshma, a couple of the questions dealt with the kind of valuation allowance questions. And, one of them had to do with if there were losses that could only be utilized against future profits of the same trade, does Pillar 2 reporting have a way to distinguish between the types of losses and how they can be utilized? From an income tax accounting standpoint, I would say that would be a factor that would be taken into account in setting your valuation allowance. So you have to look at it, and if you had NOLs that could only be used against a certain trade or business in a jurisdiction, you'd look at that jurisdiction, and then if you didn't have an expectation of future profits in the same trade or business or the type that the NOL could be used or the losses could be used against, then you would need a valuation allowance. From a Pillar 2 standpoint, Reshma, do you have any additional thoughts on that?
From a Pillar 2 standpoint, Pillar 2 has its own method for loss compensation, so it's not easy to answer that question without knowing some more background. So maybe I see a name here also. Maybe we can contact the person 101 and further discuss this.
Excellent. And then we had a question that it said, are we saying that VAs are disregarded for Pillar 2? I don't think that's what, so maybe could you go back to the VA discussion and how they're treated in Pillar 2?
No, there is no impairment or VA under Pillar 2 accounting. So all DTAs and DTLs are recognized full against the minimum tax rate for 15%. So no need to consider any VA or impairments, not even allowed. And that's also why it's not part of the ETR reconciliation for Pillar 2.
And then some of these other questions I think will be answered in future sessions about specific examples, but there was one in here around that they have an entity with a 12.5% tax rate. And so in their financial statements, they're setting up their deferred tax.
Probably Ireland.
Yeah.
Probably
so
Ireland.
They're setting their deferred tax assets or liabilities up at 12.5%. For purposes of the GLOBE rules in Pillar 2, should they be using 15%?
Yeah.
Yeah, I thought that was a relatively straightforward one. That.
And if the ETR is 12.5%, you would expect that there's a top-up tax liability for 2.5%. But it might be possible that Ireland maybe arrange something locally, an additional. Maybe QDMTT or something, or I'm not specific aware of how that works in Ireland, but the deferreds are measured against 50%. Yeah.
Okay. Well, we had a couple more questions, but I think we really don't have time to dive into any more of those. So we will get back to each of the that have asked questions, and with that, I'll let Reshma, if you want to close up in any way.
Yeah, thank you all for your attention. And if you have any questions, please, connect me or with me, or of course also with Scott. That's it.